with the confidence that I know motor well. Almost everything in motor is known to me. No, it is not like that. Very finer points and so many ticklish issues in motor, which we do not come across in our day-to-day office. Some legal provisions which will be dealt in the TP session. As far as OD session is concerned, I will deal with first part, the general regulations. There are 48 general regulations are there, GR. Most of the questions will be asked from this GRs. And in the second part, I will deal with some of the add-on covers and other special points which you can extract from the S12 tariff. So when motor was de-tariffed, what IRDA said, the policy wordings remains the same. Only the rates each company can decide. After that, many add-on covers were introduced by each company. So for these add-on covers alone, the company can decide the policy wordings and get the approval of IRDA through file and use. So remember one thing, in health, in motor, or in any other department, the questions will be asked from the policies which are common to all the four companies. In health, in miscellaneous, and motor also, each company has introduced its own policies, its own add-on covers. So the questions will not be asked from the exclusive policies or exclusive covers designed by individual companies. So here also, the tariff and GR is common for all companies. So the questions will be asked from these two areas only. The second part, which I will cover in the afternoon, will be dealing with the trade policies also. Normally, in the office, nobody knows such policies exist. Motor trade policies, many of us do not know. But sometimes they are asking the more questions from trade policies, particularly in higher cadres. Scale to 4 to 5, when appeared in 2020, at least there were 9 to 10 questions were from motor trade policies out of 30. So motor trade policies, which we normally do not come across, you have to concentrate more. That's why I have created a separate PowerPoint for motor trade policies and other aspects in the tariff. Okay. We will go through the motor. The policy covers all types of vehicles plying on public roads, such as scooters, motorcycle, private cars, all types of commercial vehicles, motor trade policies, right? As per Motor Vehicles Act 1988, it is mandatory to have a minimum third-party policy for the vehicles which are plying on the public roads, right? A certificate of insurance is as a proof of insurance should be carried in the vehicle. Earlier, we had only two types of policies, Act policy and package policy. Now, after this introduction of the long-term policies, we have at least 5 different policies which are common to the 4 companies. One is liability policy. This covers third-party liability or bodily injury liability or death and property damage. Personal accident cover for owner driver is also included. Package policy, this covers one damage plus third-party portion. Bundled policy. This has gone into so many changes since it was introduced. I think in 2018 or 19, the Supreme Court in one landmark judgment observed that almost 40 to 50% of the vehicles running on roads do not have insurance. So the persons hit by those vehicles, their families are getting affected because they are not able to get the compensation from the insurance company as well as from the insured. Even though insured is liable to pay the compensation, it cannot be legally affected. So what the Supreme Court said, at least for the new vehicles, long-term policies should be issued when they are taken for registration. So they told, leave out the commercial vehicles. It is not possible for them to pay on the day one itself for 3 years or 5 years. So private cars and two-wheelers, what they told, 5 years for two-wheelers and 3 years for private cars, the minimum insurance required when you are going for registration of a new vehicle. So at the time, the company introduced two policies. One is long-term package policy, another one is long-term act policy. Long-term package means 5 years package or 3 years package. Act also 5 years act or 3 years act. But after 2 years, such a policy of 5 years package create a lot of problems. Number one, the sum insured. As per motor vehicle tariff, sum insured should be revised for every renewal, that is every year. But when you take 5 years policy, the same sum insured remains for the 5 years. And NCB. Here, if the vehicle is running for 1 year without accident, he is eligible for NCB the second year. When you take 5 years package policy, this facility is removed from the insured. So many hardships, and also the actual valuation to decide the premiums, because the market situation may change after 2 years or 3 years. So every year the premium should be revised. That is why they have removed this long-term package policy and long-term act policy and introduced a bundled policy. Bundled policy means, again, two-wheeler policy will be for 5 years and private car policy will be 3 years. But for two-wheelers, the 5 years policy, for the 5 years, the TP portion alone is covered. OD portion is covered only for the first year. Remaining 4 years, only TP portion is covered. Same way for cars. First year package, second year, third year, only TP. Such a policy is called bundle policy. And then standalone CPA policy. 1 minute, we'll come to standalone OD policy. So naturally, when bundled policy was introduced, first year it is package okay. Second year, I have only third party cover, but I want to have OD cover also. So I go to the insurance company. Since third party cover is already there for the car, so I want to take OD person alone. So for that purpose, they have introduced standalone OD policy. So standalone OD policy will be subject to the condition you have a third party policy, valid third party policy, right? We will discuss it later. The standalone CPA policy. So in 2016, I think they have introduced this concept of owner driver cover, 19 only. What is owner driver cover? So again, it is from a Supreme Court judgment which observed that when a third party is dying because of an accident, he is compensated by the insurance company. Property damage is also compensated. When the insured himself dies in an accident, he don't have any compensation, don't have any coverage. So it is compulsory to have a owner driver cover at least for 15 lakhs. They said it is at least. So minimum coverage under owner driver should be 15 lakhs. So because of the Supreme Court judgment only this cover was introduced, right? Again, suppose a person is owning 4 vehicles, taking the compulsory PA owner driver cover in all the 4 vehicles. It is not necessary because he feels I'm not going to travel only in one vehicle at any one given point of time. So why do I should pay 4 times the premium in 4 vehicles? So for them, this compulsory standalone PA policy was introduced, where you can take out a single policy, pay a premium of 275 rupees or 300 rupees, and cover all your vehicles in a single policy. So this is called standalone CPA policy. So as of now, we have 5 types of policies: liability only, package, bundled, standalone CPA, and standalone OD policy. What is covered by liability policy? The liability policy covers owners' legal liability to pay compensation for death or bodily injury for any third-party person, which is unlimited. Damage to the third-party property, so property damage. Even now, the statutory requirement for property damage is only 6,000 rupees, but our policy automatically covers 7.5 lakhs for commercial vehicles and private cars, and 1 lakh for scooters and motorcycles. So this is the basic cover given by any liability policy. Number 1, death or bodily injury to any third person, damage to the third party property to the extent of 7.5 lakhs in private cars and commercial vehicles, and 1 lakh for motorcycles. This is the basic cover given by liability policies. Right. Now come to OD portion. Normally, we are getting claims for accident in OD. We don't know what are all the other covers available in the OD policy. But questions are asked only from the covers which we do not know. We will see what are the covers. In addition to the coverage and liability policy, this policy covers loss or damage to the insured vehicle and accessories due to fire, explosion, self-ignition, lightning, burglary, housebreaking or theft, riot and strike, malicious damage. What do you understand by malicious damage? Malicious damage is the damage done by third parties intentionally. Suppose you have parked your vehicle in front of your house, a person going there throw a stone and going away, or just making some scratches on the body of the car. So that is malicious act, that is covered. Terrorist act. Why I have highlighted this terrorist act? Because in all other policies, terrorism is an add-on cover. You have to pay additional premium to cover terrorism. But in motor policy is the only policy where terrorism is covered as an inbuilt cover, automatic cover, right? Then earthquake, flood, typhoon, hurricane. Yes, you said STFI perils, STFI perils, right? And hailstorm. Hailstorm is an extra cover because sometimes they're asking question on hailstorm. Hailstorm means the dropping of the ice cubes in the rain, with the rain, right? That is hailstorm. Sometimes the cars are getting damaged by huge stones in the hailstorm. Accidental external means, this is very clear. Then, whilst in transit by road, inland waterway, lift, elevator or air. Within India, suppose I have taken a package policy, I have been transferred to Mumbai, so I am carrying my car in a lorry. That is by road. So it is automatically covered. A package policy automatically covers this transit also. Damages during the transit also covered by either road or inland waterway, lift or elevator, even by air transit, right? Landslide or rock slide. So these 10 covers are there in every package policy. Just go through it, right? Very simple only. Just remember 2 or 3 things. One is Terrorism Act, free of cover, free cover. Then the damages sustained during the transit, either road transit or land, inland waterway transit, or even lift or airway, right? Then the policy automatically covers the towing charges and spot repairs. The towing charges is 300 rupees for scooters and 1,500 rupees for all other vehicles. You can take it as all other vehicles, either cars or commercial vehicles, towing charges. And motor road risk, the towing charge is allowed 150 rupees. Motor road risk, we will see elaborately in motor trade class. Spot repairs. What are spot repairs? Suppose the vehicle met with an accident and without doing some repairs, it cannot be removed to the workshop, nearby workshop. So I myself can do some repairs without intimating the insurance company or getting the approval of the insurance company. The insured is allowed to make some repairs, which is up to the extent of 500 rupees allowed for private car, and motorcycle it is 150. Commercial vehicle it is not there. Commercial vehicle towing charges is there, but spot repairs are not allowed for commercial vehicles. Then restricted cover. Restricted cover means fire, theft, fire and theft, all the types of 3 covers are available. Suppose I am leaving my car and going for US, I will not come back for 6 months. My car will not be coming to the public roads for another 6 months. So why I should take a full policy? So I may opt for fire and theft policy, right? Suppose I have a old car, 40 years old, which may not fetch much value in the market, but I want a cover for fire and theft. But suppose it is burnt or it is stolen, so I want a cover. But it is coming to the public road. So I can take fire plus liability or theft plus liability or fire plus theft plus liability. So those covers are also available. But this restricted cover is not available for miscellaneous types of vehicle, class D vehicles. I will explain which is class D. So miscellaneous types of vehicles, this restricted cover of fire and theft is not available. Right, come to exclusions. Regular wear and tear and breakdowns are excluded, just like in any other policy. Consequential loss. What do you understand by consequential loss? Again, this is a very big question. Many of us have wrong conceptions on this. What is a consequential loss? Suppose a vehicle is running, its steering rod is broken. So because of the breakage of steering rod, the vehicle is taking a turn and hitting a rock and getting damages, right? It is also consequential loss. Because of the breakage of the steering rod only, consequently only remaining losses happen, right? So is that not covered as per this exclusion? No. That is own damage cover, it is automatically covered. Only thing, the damage to the steering rod is not payable because it broke because of wear and tear, right? Then what is the consequential loss? I'll give you an example. I have a tourist vehicle, cab. I entered into a contract with an IT company for carrying their employees. So they gave me a contract in which I have signed. The contract says I should supply my car for carrying the employees continuously throughout the year. Suppose if I am not able to supply the car for more than 3 days in a row, I have to pay them penalty, right? This contract is between me and the IT company. So the vehicle met with an accident. Because of the accident, the vehicle cannot be used and I cannot give the car for the IT company. So because of the penalty clause, I have to pay them. So proximate cost is accident. Because of the accident only, the penalty clause invoked and I have to pay. This is also consequence loss which is not payable, right? This example can be taken for the contractual liability also. This is also called a contractual liability. Because of the contract only, I am incurring liability. Out of the contract, I am not incurring liability, right? Okay. Next. Normal exclusions, driving with invalid driving license or under influence of alcohol, war perils, claims arising out of contractual liability, I explained. Use of vehicle otherwise than in the accordance with the limitation has to use. Suppose the vehicle is to be used as a private car, it should be used as a private car only. It should be as a taxi only. So in your RC, the limitations will be mentioned. So according to the limitation only, you have to use it. Right. How it is rated, every one of you know, on various factors like IDV, the value, cubic capacity, geographical zone, age of the vehicle, GVW, gross vehicle weight in case of commercial vehicles, and based on the add-on covers. Right. How to select the sum insured? Many of us are doing mistakes, either selecting sum insured for our own vehicle or suggesting the sum insured for the client's vehicle. But the tariff gives a very clear idea. However, sum insured should be fixed either for the fresh car or renewal car. Suppose I am getting a new vehicle, ex-showroom price. What do you understand by ex-showroom price? Ex-showroom price excludes the road tax, registration charges, and insurance. So in the invoice, they will show an amount, and after that they will add insurance, road tax, and registration charges. So if you exclude these three from your invoice, that is called ex-showroom price. Many of people now asking, sir, whether GST to be included? Yes. We don't know about GST and all. GST to be included. So including GST only, it is ex-showroom price, right? So from ex-showroom price, you should reduce 5%. So first year insurance, you should insure the vehicle for 95% of the ex-showroom price, right? When it is coming for renewal, next year, we have a raw method of reducing to either 10% or 15% from the previous year sum insured. No. What the tariff says, you should apply a depreciation percentage. I will give you the percentage. So this is the percentage given by the tariff. Suppose the vehicle is coming for renewal in the second year, it shows it is 15%. The vehicle is old 6 months to 1 year, so you should reduce 15%. So what we used to do, we reduce 15% from the last year's sum insured. No, the tariff says if a vehicle coming for renewal in the second year, you should ascertain the ex-showroom price of that particular model vehicle on the date of renewal and reduce it by 15%. I'll give an example. Hyundai Creta purchased for 10.50 lakhs, insured for 10 lakhs in the first year because 5% is reduced, right? Coming for renewal in the second year. As per GR8, you should reduce 15%, not from the previous year IDV, but from the ex-showroom price of the same model car on the date of renewal. Assume that the ex-showroom price of the same model car on the date of renewal is 12 lakhs, not 10.5. The price has gone up. So from 12 lakhs, you apply 15%. So the IDV will be 10.20 lakhs. Please note, last year IDV is 10 lakhs. Second year IDV is 10.2 lakhs. That means IDV has increased. But we have a misconception that every year IDV should be reduced. No, it is not the case, right? So you should ascertain the ex-showroom price of the same model car on the date of renewal and apply the percentage and reduce it. Then only you can arrive the IDV, right? This formula is applicable up to 5 years. After 5 years, the tariff says the insured and the insurance company to understand, come to understanding of the IDV, what amount we should insure it for, right? Okay. This is the legal provisions. The MB Act says of section 147 of MB Act says what is the minimum coverage required under an insurance policy, right? It says against any liability incurred for insured death or injury to the third person, property damage 6,000, death or bodily injury to any passenger in a passenger carrying vehicle. It is automatic. So legal provision says the passengers mandatorily should be insured, and death or bodily injury to workmen, right? Among the above, all personal damages are unlimited. Only property damage is limited to 6,000. Or personal damages are unlimited, right? Transfer. So as per tariff, as per MV Act, the vehicle is considered that it is transferred to a new person only when it is changed in the RC. Till such time, it is not considered as the transfer has been effected, right? So when the RC name is changed, the purchaser should approach the insurance company within 14 days of name transfer in the RC and apply to us with a new proposal and pay the required fees and NCB recovery. Then only the name is transferred in the policy. In case of death of the insured, what will happen? After the death of the insured, the grace period given in the Act and tariff is only 3 months or next renewal, whichever is earlier. Suppose the policy is expiring on 31st December, the person dies on 1st December, so the grace period is only 1 month because it is coming for renewal in the 31st December. The logic is insurance is a contract. In general insurance, the contract is renewed every year. Every year, a new contract is created. On 31st December, the person is died already, so he cannot enter into contract. So the grace period given in the tariff and act for case of death of insured is 3 months from the date of death or date of next renewal, whichever is earlier. Suppose that doesn't happen, the insured is not, the legal cause of insured is not informing us about the death, then the policy automatically lapses as far as OD portion is concerned. TP portion is continued, no issue. But OD portion lapses after 3 months of the death of the insured, right? We have seen the general aspects of the tariff. We will go to GRs one by one, which is very important. We will break for 10 minutes for tea. Now the time is 11:35. So we will assemble by 11:45 positively. Okay. Even I request not to disconnect your connections. You may enter into problems while reconnecting. So just leave it and come back after 10 minutes. Thank you. Friends, I think we shall start. Okay. Friends, hope you have assembled. We will see the GIAs which are very important one by one. Some of them are very simple and some of them are you have to remember by heart. So we will go one by one. There are 48 general regulations. In some books they have given 47. When they were introduced in 2002 July, it was 47 only. In December 2002, they have introduced one more GR called as additional towing charges. So now GRs are 48. Motor insurance, GR1 says motor insurance includes private cars, motorized two-wheelers and commercial vehicles, excluding the vehicles running on rails. Which are the vehicles running on rails? Our regular trains, monorail and trams. So all these things cannot be insured under motor policy. GR2, proposal form is a must for motor insurance for fresh renewal and any material alteration. Unfortunately, we are not following it for anything, even for fresh renewal, any change, we are not getting a proposal form, which end up in so many legal consequences. So please try to get proposal form filled for fresh or renewal or any other material alteration. There are two policy forms prescribed in GR3. One is liability and another one is package policy. Restriction of cover under section 1 without deduction of premium is allowed. So this is immaterial now. What they said initially when the tariff was in force, the minimum premium was prescribed by the tariff. So what the tariff says, out of 10 covers given an OD section like STFA, perils, earthquake, landslide like that, you can restrict the cover. You can remove 1 or 2 covers, but you cannot reduce the premium. Now the premium portion is given to the companies, so it is irrelevant now. Okay. Normal area of operation for motor vehicles is India, but tariff provides for the extension of the geographical area. You can extend it for 6 other nations, our neighbors: Bangladesh, Bhutan, Nepal, Pakistan, Sri Lanka, and Maldives, which are our immediate neighbors, or otherwise SAARC countries. You can remember them as SAARC countries. So the insurance taken in India can be extended to cover even when the vehicles are moving into these 6 countries, any of these 6 countries. But it should be informed, prior intimation should be given. What is additional premium? For package policy, it is 500 rupees per vehicle. For other policies, that means liability policy, it is 100 rupees per vehicle, irrespective of the class of vehicle. Even if it is two-wheeler, private car, commercial vehicle, whatever it may be, if it is a package policy, you have to remit 500 rupees and other policy is 100 rupees. Also, the period in which the vehicle is going to get operated in the other country is also unlimited up to the period of insurance, though no time limit is prescribed. So you have to remember which are all the 6 countries and what is the premium involved, right? Then during such geographical extensions, however, specifically exclude cover for damage to the vehicle or injury to occupants or TP liability in respect of the vehicle during air passage, sea voyage, and for the purpose of ferrying the vehicle to the extended geographical area. We have seen earlier, within India, the transit of the vehicle in some other mode is also allowed. Suppose I am carrying a car in a lorry, it is allowed. Package policy covers. In inland waterways also covered, airlifting is also covered. So within India, all transit covers are there for a package policy. However, when it is extended for the additional countries, If it is taken through road, it is covered. So transit through road is covered. But transit through air passage or sea voyage is not covered. Please understand. Sometimes they are asking the questions on this. During geographical extension, even if you have paid the money, if the vehicle is taken by land, it is covered. But air passage or sea voyage is not covered. IMT one should be used. Sometimes many people are asking, sir, this IMT and GR, whether we have to remember the numbers. It is not necessary that you should remember the numbers of GRs and IMTs, but some important IMTs you should remember, IMT 21, 23 like that, I will tell you. But try to go through another PPT, I will give you, where I have compared all the GRs and IMTs. You just go through whatever we have learned, only there it is coming, but there each GMT is GR is compared with the IMT involved, right? Okay. Next one, vintage cars. Vintage cars means manufactured prior to 31/12/1940 and certified by Vintage and Classic Car Club of India. There are two conditions. You should have manufactured prior to 31/12/1940 and also certified by Vintage and Classic Car Club of India. Then only it is called as a vintage car. Classic car manufactured prior to 31/12/1970, but after 31/12/1940. These 30 years, it is called classic cars, right? What is the difference as far as tariff is concerned? The classic cars are covered by normal motor policies, like any other car. Then why there is a classification called classic cars? We don't know. It is there. You just remember the period in which the classic cars are manufactured, between 31/12/1940 and 31/12/1970. There is no special treatment given to classic cars in motor policy issuing or motor tariff. It is just like same as normal regular cars, right? But as far as vintage cars are concerned, we can issue valued policies, or in other words, agreed value policies. Because of its antiquity, we give valued cars, valued policies. What do you understand by agreed value policy? In general insurance, there are few types of policies: market value policy, agreed value policy, like that. What is a market value policy? We are insuring the property for the value at which it can be sold in the market. That is called market value policy. Agreed value policy means the value is agreed between the insurer and the insured even before commencement of the policy. And in case of a total loss, the sum insured is payable without going for inquiry about the market value of the property. So motor tariff says vintage cars can be issued with the agreed value policy. That means in case of a total loss, the sum insured is paid, right? Okay. This is the table given by tariff for arriving at IDV. This is also called as depreciation table, but which is totally different from the depreciation applicable on the parts for calculating the claim liability. This is the depreciation table applied to arrive at IDV, right? So the IDV, as I explained you, should be arrived from the ex-showroom price of the same model of the car on the date of renewal. And from that value, you have to reduce the percentages given up to 5 years. Not exceeding 6 months, 5%. That is why new cars are given insurance for only 95% of the ex-showroom price. 6 months to 1 year, 15%. 1 to 2, 20, 30, 40, 50. Right? Above 5 years, and also for obsolete models. Some cars may become obsolete even before 5 years. The model may not be available in the market. So we have to fix a price after understanding between the insurer and the insured, right? In case of a total loss or constructive total loss, the IDV is payable. So it makes partially the agreed value policy. For partial losses, we are paying just like as market value policies. But this clause in motor tariff makes the motor policy as partially an agreed value, because it clearly says in case of a total loss, you have to pay IDV. Practically, we are not doing it. Forget about that. After total loss, we are arguing with the insured. The surveyors are giving, no, sir, this vehicle will not fetch so much of value. Market value is only this much. So you have to only settle this amount. And we are arguing with the insured. You should not do that. As per motor policy, IDV is payable in case of a total loss. There is no ambiguity. There is no question at all. You have to pay the sum insured, even if it is insured for more or it less. We don't know. Suppose the vehicle is not fixed as per the table given by the GIEAIA, then it end up in a total loss. Even then you have to pay IDV. There is no question, right? The second point given by the tariff is, suppose the assessed loss is more than 75% of the IDV, then you have to consider it only for total loss. You cannot go for repair loss. This is also a condition given in the tariff. Either the insured or the insurer don't have any choice. Assessed loss means the net company's liability for a repair loss, including towing charges, excluding excess, excluding salvage. So this is the assessed loss. That is the net liability of the company. If the net liability of the company is more than 70%, then that claim should be settled only for total loss. You cannot go for repair loss. If the insured is requesting also, the insurance company will not agree. It will go for total loss only. Neither the insurer nor the insured has any choice. They should settle for only total loss. Right. Now GR9, it is showing the depreciation table should be applied on the parts when we are settling the claims. Right? All rubber, nylon, tires, tubes, batteries, airbags. It is 50%. Even from day one, it is 50%. All fiberglass parts, 30%. What do you understand by fiberglass? Fiberglass mostly used in commercial vehicles to build the front panels. Glass parts, nil, no depreciation, whatever may be the age. Other parts, not exceeding 6 months, nil. 6 months to 1 year, 5. 1 to 2 years, 10. Then 15, 25, 35, 40. About 10 years, it is 50. Most of the people handling the claims will be remembering this by heart. But from examination point of view, every one of you should remember this by heart. Because sometimes they may ask only questions like, what is the depreciation for a metal part between 3 to 4 years? Like that they also ask. Otherwise, they will give a numerical problem where you have to calculate the depreciation by your own. So for that also, you have to remember this table. There is no other choice. Please make it by heart. You have to remember these percentages. Then what about wooden parts? In many of the commercial vehicles, there are wooden parts. What is the percentage to be applied for wooden parts? The same as other parts, because the tariff says other parts. It is not mentioning as metal parts. If it has mentioned as metal parts, you may say it is only for metal parts. Wooden parts have a different depreciation table. But since it has said other parts means other than the above three: glass, fiberglass, and the rubber nylon parts. So other than these three, everything is coming under other parts. So wooden parts naturally having the same percentages, right? Once they have asked about the wooden parts depreciation. Geographical zones. Why there are geographical zones? It was found from the statistics that the vehicles flying in certain zones are meeting with more accidents. So naturally, they should be charged more. So for private cars and two-wheelers, only two zones, A and B. The zone A, 8 cities, 4 metros, that is Calcutta, Mumbai, Delhi, and Chennai. And 4 new metros. These 4 cities are called new metros: Ahmedabad, Hyderabad, Bangalore, and Pune. So 4 metros, 4 new metros forms the zone A, where you have to pay. Suppose you are flying the car in that zone, you have to pay more. Zone B is rest of India. For all other vehicles, in commercial vehicles, there are 3 zones. Zone A, metros. Zone B, all state capitals. Zone C, rest of India. Right. Another question comes: how to fix the zone? Based on the registration or based on the flying area? It is clearly said the registration. Suppose a car registered in Chennai, flying in Madurai, the car should be charged as zone A only, right? So the registration area is deciding the zone, not the flying area. Period of insurance is 12 months. No policy can be issued for more than 12 months, right? But the policies can be extended. Many corporate clients having more than 100 vehicles, 200 vehicles. Suppose they expire on different dates based on their purchase date, they may fail to renew properly. So they want that all the expiry dates of their policies should synchronize, right? On a particular day, like 31st March or 31st December, like that. So if the such request is made from a client, you cannot issue a first policy for lesser than 12 months. Then they have to pay short period policies. They have taken 1 year policy for registration, fresh vehicle. Then they extend it for the another 3 months or 6 months based on their synchronization date. So if they want such extension, get a declaration from the insured stating that the reason is for synchronization and please charge only pro rata premium. We will renew the vehicle only with your company on expiry. Such a declaration is given by the insured. In that case, we can charge pro rata for extension of the policy. In case the policy is not renewed with us, the insured has to pay the difference between the short period scales and the pro rata scales. Practically, is not possible because when the insured is not renewing with us, where to catch hold of him? He has already gone to some other company. So theoretically, you should understand that such extensions for synchronization of date is allowed on pro rata basis. If they are not renewing with us, then the difference should be received. Okay. Short period scales. What is a short period scales? Why we are charging more for a short period scale? Normally, all general insurance policies of 12 months. So the Insurance Act clearly says you should not pay the premium on installments. Full year premium you should pay in a single shot. Suppose we are allowing only pro rata for short period policies also, what will happen? The insured will pay only for 1 month and renewing it for every month. He is not losing anything, but he is paying virtually the premium in installments. But for us, instead of 1 policy, we have to issue 12 policies. Clerical labor is involved. So we are getting more expenses. To avoid this, all the tariffs are prescribing short period scales. But while remembering the short period scales, one point you should remember, the short period scales given for different departments are different. The short period scales given in fire tariff is different from water tariff. It is different from engineering tariff, different from WC tariff, like that, right? So you remember for motor, then whenever the next class comes, that short period scales also you should remember, right? For the people from United India, in fire, now United India has got an approval for, and file and use for a reduced short period scales, which is somewhat lesser than the short period scale prescribed in the fire tariff. But as far as exam is concerned, you should write the short period scales given in the tariff only, not the short period scales used in the office, as far as fire is concerned for United India people, right? So motor, not exceeding 1 month, it is 20%. You should remember like this: if it is 1, it is 2. 1 month 20%, 2 months 30%, 3 months 40%, 4 months 50%, like that. For 8 months it is 90%, and more than 8 months it is full premium. So like that you have to remember. Again, this also you have to remember. Extension of short period covers. Suppose a person has taken 3 months short period, right? And he is coming and renewing it for another 3 months. You have to apply a fresh 3 months tariff, not 6 months tariff, right? Like that, you have to extend the short period policies only by charging short period scales only. Display of premium. Tariff clearly says the premium should be displayed in the policy given to the insured. All the components like loadings and discounts should be displayed in the policy. But many of the companies are not displaying now. Even I think New India is not displaying the NCB amount. The bottom of the schedule, it is prescribing the NCB percentage only, not the NCB amount, right? But as per tariff, all the components of the premium calculation should be displayed on the schedule given to the insured. Computation of premium, these are all very irrelevant now, but anyhow, for examination point of view, required to be calculated into the accordance with the premium computation tables in the tariff. That is, what is the basic premium and what are the loadings, what are the discounts, what is the sequence it should be added or reduced. The sequence is given in the tariff. The NCB is coming in the last. So after all loadings and discounts only, you should calculate the NCB. Like that, the sequence is given in the tariff. That sequence should be followed. Payment of premium, as we said, it should be given in a single installment. Minimum premium, again, it is relevant again for the sake of examination. You should remember, for all policies, the minimum premium is 100 rupees. For all vehicles, the minimum premium is 100 rupees. But if the vehicles are specifically designed or modified for the use of blind or handicapped persons or mentally challenged persons, it will be 25 rupees only, right? So you just remember, the vehicles specially modified for the use of handicapped persons, the minimum premium is 25%, 25 rupees. All other vehicles, it is 100 rupees. Even it is irrelevant because whatever sum insured is there, now the premium is more than this only. Transfer we have already discussed, 14 days. Suppose even after the name changed in RC, they have not come to insurance company. In that case, automatically after 14 days, the one damage portion is lapses, the third party portion continues, right? If the transfer is not entitled to the benefit of the no claim bonus, as per the NCB rules, we will see, then he should repay the proportionate NCB from the date of transfer till the expiry of the policy, right? Yes, we said it should be fresh proposal should be received and signed by the insured, and certificate of insurance should be surrendered. We have to pay a new certificate of insurance in the name of new purchaser, and 50 rupees fees also should be paid. Then change of vehicle. Suppose I have a old car, Maruti. Now I am going for a new car. In the Maruti policy itself, I can replace my new car. In the same policy, I am replacing Maruti with Creta. So like that, I can replace the vehicle. So what is the benefit means? Suppose there is already NCB is available in the policy, that is NCB is automatically carried to the new vehicle. That is the benefit. But again, this is only theory now, because nowadays new vehicles registration, they require 3 years or 5 year policy. This 1 year policy they will not accept. But theoretically, it is possible to replace the new vehicle in the old vehicle policy. Okay. There are some 3 agreements. There are questions in the previous years on this: hire purchase, lease agreement, and hypothecation agreement. What is a hire purchase? Hire purchase means actually the owner is the financier. Legally, it is the legal provision. Even though the vehicle is registered in the person name who is operating the vehicle, legally, the person who has financed the vehicle is the owner. So every month he has to pay a higher amount to the financier. But motor tariff clearly says we should issue the policy only in the name of the registered owner. Only in the name of the registered owner, not to the financier's name. His financier's interest is taken care by endorsement IMT 5, incorporating the financier name, and whatever the losses payable will be payable to the financier only, unless an NOC is obtained. Then comes to legal lease agreement. Policies and certificates of insurance are to be issued in the name of lessee, and issuance of the joint names of the lessee and lessor is prohibited. Again, here also, there is one difference. One minute, we'll go to hypothecation and come back. Hypothecation is same as hire purchase. Here also, the registered owner is the actual person who is operating the vehicle. So we should issue the policy in the registered owner only, right? Come to lease. I told you, I have a taxi. I have leased it to a company, IT company. There is a lease agreement. The lease agreement says, I have handed over the vehicle. The person who has taken it on lease should take care of the insurance, repairs, maintenance, everything. Suppose the contract says like that, naturally, the person who is taken on lease will have insurable interest on the car. So he can take the insurance on his name. But original RC is in my name. So in this case, if the contract says the responsibility of taking insurance is lying with the person taken on lease, so he can take the policy in his name. The lessor's interest is notified in the IMT endorsement 6. Hypothecation we have discussed. Cover note. The younger ones, the younger employees do not know what a cover note is. In earlier days, the preparation of policy takes time. Whenever a policy comes to office, we have to underwrite it, and the premium is received, and it has to be typed. There were no computers in those days, so it has to be typed physically and stamped and signed, and it has to go. So this will take some time. But for the purpose of registration, yes, some document is required. Yes, a proof of insurance that the vehicle is insured that proof is required. Such a proof is called cover note. Cover note is only temporary document issued as a proof of insurance, and cover note is valid for 15 days only, which can be extended by 15 days a time, maximum of 3 times. That means the initial validity period is 15 days and can be extended by 15 days into 3, 45 days. So total validity of the cover note is 60 days. Beyond 60 days, you cannot renew a cover note. Before that, the policy has to be substituted. And once the policy is issued, the cover note automatically lapses. You cannot use the cover note again, right? But the cover note should be issued in the format given by the Motor Vehicles Act in the form number 52. The form number 52 describes the format in which a cover note should be issued. Certificate of insurance. What is a certificate of insurance and what is its necessity? Certificate of insurance is a proof of insurance where it is mandatory to have insurance. For example, third party liability is a mandatory insurance required by MB Act. So certificate of insurance is the document which should be shown to the statutory authorities like police or RTO people as a proof of insurance. So wherever there is a legal requirement, the property should be mandatorily insured, then the certificate of insurance is coming into picture. In other departments like marine export of insurance, it is mandatory to have insurance. Export of goods, it is mandatory to have insurance. So in marine also, for export of goods, we are issuing certificate of insurance, right? So certificate of insurance is a proof of insurance where it is mandatory to have insurance on that property. Certificate of insurance should be issued in the format given in the form 51 of motor vehicle rules, right? Now GR 24, there are 2 parts. On A, cancellation of insurance. It is just like any other policies. Insurer can cancel the policy by sending 7 days notice, but the refund should be on pro rata basis. The insured can cancel the policy by giving 7 days notice, but the refund will be based on short period basis, right? The refund will be subject to there is no claim. Suppose there is a claim, and after that, either way, either insured is cancelling or insurer is cancelling, there is no refund, right? Once there is a claim is reported, no refund. Retention of minimum premium, that is 100 rupees minimum should be retained. A policy can be cancelled only after ensuring that the vehicle is insured elsewhere, at least for the liability only cover. Since it is mandatory to have a insurance for any vehicle, suppose the insured is cancelling the insurance with us, he should give a proof that the vehicle is insured elsewhere, at least for liability cover. Then only we can cancel the policy. Again, there is an exception where the vehicles which are going to be destroyed and RC has been cancelled by RTO, we can cancel the policy without the proof of elsewhere insurance because there is no physical existence of the vehicle. We can cancel the policy, right? Insurers should inform the RTO concerned in recorded delivery of such cancellation. When the policy is cancelled, the insured might have given the proof of insurance to the transport authorities when it is going for registration or FC like that. So the document will be lying with them. So when we are cancelling the document, we should inform them about the cancellation. Double insurance. I will give you a general view. Instead of going through the elaborate wordings, double insurance occurs in 3 forms. 1, it is with the same insurer. Both the policies are taken with the same insurer. So naturally, whatever may be the liability, it is coming on the insurer. So we can cancel the later policy, the policy issued later, and giving 100% refund. There is no issue because liability is fixed, right? The second chance, both the policies, each policy is taken with a different insurer, right? Suppose the latter policy, again, the latter policy should be cancelled. The latter policy is cancelled before its own commencement, then 100% refund can be allowed. Suppose the second policy also run into the period of insurance for some time. For example, policy A starts on 1st December. Policy B commences on 15th December. The insured is coming to us on only 30th December for cancellation of the second policy, latter policy. Both the policies are ran in overlapping period of 15th December to 30th December. Suppose something had happened in this period, both the policies are liable on contribution basis. So, while cancelling the policy, the second insurer should retain the premium for the period from 15th December to 30th December on pro rata basis and return the balance premium only, not 100%. We are thinking that double insurance means 100% refund. No, it is decided by the date on which the insured is applying for the cancellation of the policy. If the applying before the commencement of the period of insurance, then 100% refund. If the period of insurance already commenced, then pro rata premium should be retained from the date of commencement till the date of cancellation. It should be remembered. The third chance, both the policies have identical periods. Then it is the choice of the insured. He can cancel any of the policies with getting 100% refund. Another special occasion, two policies are issued, right? First policy is without banker's interest. The second policy is issued with the banker's interest. If second policy is retained, then only the banker's interest is retained. So to safeguard the banker's interest, the earlier policy can be cancelled. The earlier policy can be cancelled. But the earlier policy is cancelled from the date of its commencement till it gets cancellation. You should retain the premium on short period scales. Because it is a special occasion, we are going against the guideline. So we are cancelling the date of commencement to date of cancellation, retaining the premium on short period scales. So if you want to cancel the earlier policy, it is only on one occasion where you have to safeguard the banker's interest. Then only you can cancel the earlier policy. In all other cases, later policy should be cancelled. When the certificate of insurance is lost or misplaced or destroyed, so you have to pay 50 rupees for duplicate fee. Now come to no claim bonus. No claim bonus, we have certain set of rules. First, go through the percentages. First year, completed full year without claim, 20%. 2 years, 25, 3 years, 35, 4 years, 45, 5 years and more, it is 50%. So this scale of NCB came into effect from 1st July 2002. Before that, there was a different scale. In that scale, commercial vehicles were enjoying 65% maximum. Private cars and two-wheelers were enjoying 55%. Suppose a vehicle having 65% before 2002, coming for renewal after 2002 without accident, as per new tariff, it should be maximum 50% only. So we cannot reduce it to 50%. So we have to maintain 65%. For private car and two-wheelers, 55%. So this is called sunset clause. You should remember the name sunset clause in motor for NCB, which says the vehicles which were enjoying higher than 50% NCB prior to 2002 and they are not meeting with an accident during renewal, the old rates will apply, will be maintained 65% or 50%. Till what? Till what time? Till what time? Till it reports a claim. Suppose for 5 years they are not reporting a claim till 2007. So you have to continue 65% till 2007. Once claim is reported and settled, it will become zero and start growing again from 20, 30, 40, 50. There it will be stopped with 50. Right? So whatever they were enjoying should not be reduced. That is the logic. So this is called sunset clause. So other rules. The NCB entitlement follow the fortune of the insured, not with the vehicle. The NCB is enjoyed by the insured, not by the vehicle. So whatever the insured is getting, he can carry it to his new vehicle, right? It can be substituted to the insured purchasing a new vehicle. Here again, most of us believe that the old car should be sold. It should not be in the insured's name. Then only we can allow the old NCB to the new car. Absolutely, it is wrong. The logic is the NCB enjoyed should be for only one vehicle at any given point of time. Suppose I am having a Maruti, 50% NCB is there. Now I am going for a Benz, which is 50 lakhs, sum insured. You have to transfer 50%. What we can do, in the policy issued for Maruti, you can ask the insured to repay the NCB from the date of purchase of new car till the expiry of the old policy. The proportionate amount the insured is repaying in the Maruti policy and getting a NCB certificate stating that the so-and-so insured is enjoying a 50% NCB on private car. He can give the certificate to the new insurer of the new car and get the NCB. Only condition is the NCB is transferred only for the same class of vehicle, same class. Two-wheeler to two-wheeler, private car to private car, taxi to taxi, lorry to lorry, bus to bus, like that. Same class of vehicle. You cannot carry a NCB enjoyed in a two-wheeler to a private car. But if it is registered as a private car, the sum insured or the value is immaterial. A 50% NCB enjoyed for a car of 50,000 can be carried forward to a car of 50 lakhs. Only thing is it should be registered as a private car only. So you should understand that two things, it should be within the same class and the insured need not sell the old car. He can have the car without NCB, that's all. So NCB is enjoyed in only one car, right? On death of the insured, NCB can be passed on to the legal heir who inherits the vehicle. NCB can be passed on to the legal heir of the insured, no issue. Next one, the vehicle owned by institution exclusively used by a single person. In that case, when the name is transferred from the employer to employee, the NCB can be transferred. You should remember the best example, our own DMBM's vehicles. Our own DMBM's vehicles insured in the company's name, but exclusively used by the single person. After 5 years, when the BM or DM is transferring the name from the company's name to his own name, the NCB can be transferred, no issue, right? I will give you another example. There is a pool car owned by United India. It is registered in the United India name. After some 10 years, it is given on auction with the condition that only employees can take it. One employee is taking the vehicle on auction. Here also, the car is from employer name to, it is going to the employee name. But the first condition is not obeyed. It says owned by an institution and used exclusively by a single person. When it was a pool car, it was used by everyone, not the person who is taking the car on sale. So in that case, NCB cannot be transferred. So best example, our DMBM cars, they can carry forward or transfer the NCB when the car is transferred into his name, right? Suppose I am selling the car, immediately I am not taking the new car. So I can get a NCB certificate and I can take the new car within 3 years and transfer the NCB. One time a question was asked, 3 years from which date? My policy is from 1st January to 31st December. I sold the car on 1st June. So the 3 years starts from which date? 1st January or 1st June or 31st December? The actual answer is 31st December of the earlier year. In other words, the 3 years starts from the expiry date of the previous policy. You just understand why it is so. On 31st December of previous year, the insured is entitled for 50% NCB, right? Only 6 months have gone. Suppose something happens in the remaining 6 months, he will lose the NCB. So his entitlement will go. So he has full entitlement only on 31st December of the previous year. So these 3 years always starts from the date of expiry of the previous policy. You should remember that. You should give a certificate like that only. Okay. Normal grace period for renewing the policy with NCB is 90 days. But for military personnel, it is 365 days. But depending on individual case, and they should give proof they were posted elsewhere and they are not able to renew the policy. NCB to be calculated after deducting the rebate given for laid up. We will see the laid up later. So NCB to be calculated after deducting the all rebates. I told you NCB is the last item in the OD premium calculation, always. NCB is to be allowed only when the vehicle has been insured continuously for a period of 12 months. Suppose I have taken a policy for 1 year. So I enjoyed 20% in the second renewal. But the second renewal I have taken only for 8 months. So when my 8 months policy is coming for renewal, I cannot go to the next slab. I will enjoy again 20% only because the second policy has not completed 365 days, right? So when the policy has completed 365 days without accident, then only the NCB eligibility will move to the next slab. Otherwise, it will continue in the same slab. Not applicable for motor trade policies. If period of insurance is extended, the extended period is deemed to be part of the preceding year of insurance. Yes, I told you 1 year extended for 8 months. So it will be 12 plus 8, 20 months only. It will not be carried with the coming year. So preceding year only it will be added. NCB earned abroad can be given to the new policy taken. The NCB taken, NCB is for the current vehicle, just like transferred to the new vehicle. NCB enjoyed by the insured in abroad car also can be carried forward to the new car purchased in India. Suppose within it is 3 years again. Automobile Association membership, these are irrelevant in the current scenario, but examination point of view, you should remember 1 or 2 numbers. What is Automobile Association? There are Automobile Association where an individual or company can become members, where they will teach you the safety of the car, right? So if a person is a member of the Automobile Association, a discount is allowed maximum of 5%, subject to a maximum of 200 rupees for private car and 50 rupees for two-wheelers. There is no discount for commercial vehicles. Pro rata discount is allowed from the date he is becoming member. Individuals, joint owners, and companies who are members of Automobile Association are eligible. Very simple, right? 5%, maximum 200 for private car, 50 for two-wheeler. You should remember these three numbers. Discount for vintage cars. We have already seen vintage cars can be issued with agreed value policies. Also, there is a discount for vintage cars. It is 25% on OD premium and 50% on TP premium. Earlier, it was discount only for OD section. From 2018, the GIEAIA says, so TP premium also can be reduced by 50% because normally vintage cars are not running on the roads most of the year. It will be taken only for exhibitions or sometimes it is for rallies and all. So vintage cars are given. Remember, 25% on OD, 50% on TP. Midterm also, certification also, we can give pro rata refund. Anti-theft vehicles. What is an anti-theft vehicle? Sorry, anti-theft devices. Anti-theft devices means some device fitted in a car which will give an alarm when somebody is trying to illegally take out the car. So if the car is fitted with such anti-theft device and it is the device should have been certified by Automobile Research Association of India, Pune, then only it is eligible. Suppose I am getting this anti-theft device from market and fitting it means I cannot get a discount. The device should have been fitted and it should have been approved by ARAI Pune. The discount is 2.5% on OD component alone, subject to a maximum of 500. It is not mentioning the class of vehicle. So this discount is applicable for all the vehicles, two-wheelers, private cars, and commercial vehicles, anything. Now come to laid up. Many of us come to know about this provision only during the COVID period, right? So what is the necessity for this class? First, you should remember, there are certain occasions when the vehicle is not at all used for a longer period. Suppose I am going to US for 6 months, I will not come back for 6 months. So I am laying up my private car. I will not use it at all. So in the package policy taken by me, what I should do, I should give a initial information before the layup period starts. Before the layup period starts, I should give written intimation. Number 2, I should surrender the insurance certificate. Why? Because I am not going to use the vehicle. Why insurance certificate is required? It should be shown to the public authorities when it is playing on a road. It is not going to come to the road. So I should surrender the insurance certificate. And documentation charge of 15 rupees should be paid. If all the 3 conditions are obeyed, then only your laid up period starts. Or even for starting of the laid up period, these 3 conditions should be obeyed. Written intimation, surrender of certificate, 15 rupees payment. Right. After surrendering doing all these formalities, I am going back after some 3 months or 4 months, right? But the tariff says minimum of 60 days. The layup period should be minimum of 60 days. Then only layup concession is available. So suppose I have transferred I have given writing, I have surrendered the certificate, 15 rupees paid. But suppose I'm coming back after 45 days and asking for revival of the policy, then there is no refund. There is no laid up condition applicable, right? So minimum 60 days. So first part is over. Suppose after 5 months, I am coming and asking the insurance company, revive my policy, give back by insurance certificate, right? So for this 5 months, yeah, refund is eligible. But that refund should not be paid in cash. That means either my period of insurance can be extended by 5 months, or the eligible refund amount can be adjusted against the immediate next renewal. So I am not giving cash refund. The insurance company either adjusting the premium in next renewal or extending the policy for so many days of laid up. Right? Another thing, for private cars and two-wheelers, no certification from transport authorities is required. Whenever insured himself is declaring and surrendering the certificate, it will be okay. But all other vehicles, for example, commercial vehicles, the certification from the transport authorities is mandatory, stating that they are not using the vehicle, so they are exempted from paying the tax. Then only layup period for commercial vehicles can be considered. So it is not like two-wheelers or private cars. For commercial vehicles, one more document is required, which will be supplied by the transport authorities for cancellation of the permit for the given period. Then only they are eligible for laid up concession, right? So 3 or 4 points you should remember: initial written intimation, surrender of certificate, 15 rupees, minimum 60 days. For commercial vehicles, one more document is required: certification of permit cancellation from the transport authorities, right? So if everything is okay, then also the vehicle is lying within the compound, it is not coming to the road, something happens due to fire or theft, whether it is covered during the layup period? Yes, because our layup says, see the last line, all other perils operate except accidental external means. That means out of 10 perils covered in motor OD portion, only 1 peril is suspended. That's like all other perils like burglary, theft, STFA perils, earthquake, fire, everything is continue to be covered even under the layup period. For this amount, the system will charge some amount which is payable by the insured or adjusted in the refund calculation. Balance only allowed as refund, which will be adjusted against the future renewal or policy is extended, right? If he is paying the premium, the difference amount, the policy will be extended. Okay. Okay. All these points we have covered. Perils covered during the later period. We have seen 10 perils out of 10 perils, except accidental means every peril is covered. Okay. This is again irrelevant. Midterm exclusion or inclusion of extra benefits cannot be done. Suppose I want to cover one extra benefit. For example, I have fitted with some additional electronic devices. So I want to include them. So such addition or deletion can be done only once inside the current policy period, right? GIEAIA 33, concession for specially designed or modified vehicles, right? We have seen the minimum premium also different for the vehicles modified for usage by the handicapped persons. Here, GIEAIA 33 says there are 2 types of vehicle eligible for 50% discount. One is what we have seen earlier. The vehicles specially designed or modified for usage of blind, handicapped, or mentally challenged persons. The other one, the vehicles owned by institutions which serves exclusively for these handicapped persons. So two category of vehicles. One is vehicles specially designed for usage of handicapped persons. The other category is vehicles owned by institutions which exclusively service these handicapped persons. These two categories of vehicles enjoy a 50% discount on own damage premium. Right. Registration, it is not permissible. We have already seen it should be insured only in the name of the person in which or she is registered. Joint names is not allowed. Some other name is not allowed. Right. Number GIEAIA 35. Use of vehicles within insured premises. Sometimes many excavators, lifts, so such rigs, such vehicles are used inside a compound. They are not coming to the public road. So those vehicles we can give a 33.1/3% discount. But it should be ensured not authorized by RTO to run on public roads. The RC itself or permit itself, they have mentioned it should not come to the public road. No certificate of cover or cover note should be issued, because I told you why a certificate of insurance is required. It should be shown to the public authorities when the vehicle is plying on a public road. Here it is not going to public road, so no certificate should be issued. Right. There is only one exception given by the tariff. Suppose it is operating inside a compound. It is utility is required to firefight. Suppose carrying water or to save the vehicle from the fire, right? In a firefighting operation, it is coming out of the compound to the public road, right? It is getting damaged, it is payable. So the only exception is when the vehicle is running on a public road in a firefighting operation. The claim is payable. PA. PA, you should understand, 2 or 3 sections are there in motor policies for PA cover, which are mutually exclusive. That means category covered by one section is not covered by any other section. So you should use only the particular section for that particular person. Owner driver is a separate section. That means owner cannot be covered by any other PA sections available in motor policies. For example, unnamed. There is unnamed PA is there. Driver, paid driver PA is there. So in those sections, owner cannot be covered. When there is an exclusive section for owner PA, right? Yes, I mentioned earlier the owner PA was 1 lakh and 2 lakh. Now it has been fixed as 15 lakhs by Supreme Court. Minimum. So when a person is coming for insurance, it is called CPA, compulsory personal accident owner driver. But it is no more compulsory. Why? There are 2 occasions. One, what is actual eligibility for the owner to be covered under this section? Number 1, the vehicle should be registered in his name. Number 2, he should have a valid driving license to drive that particular class of vehicle. If both the conditions are obeyed, then only he is eligible to be insured under this section. Suppose a vehicle is insured in a person's name, but he don't have a driving license at all, then he cannot be covered under this section. Suppose the vehicle is registered in a firm's name or company's name, again, it cannot have this section because it is a firm, it is not a person. So it cannot be insured, right? So these 2 areas are exceptions. When the person is not having driving license owner, you cannot insure him. If the vehicle is insured in company's name, then also you cannot take this section, right? Then the clause very clearly says when the vehicle is registered in his name and he is having a valid driving license to run that class of vehicle, if he dies in an accident, either while driving the vehicle or traveling in the vehicle as a co-passenger or co-driver. That means it is not necessary that the person is driving the vehicle at the time of accident to get the claim. Only two conditions are registered in his name, he is having a valid driving license. That's all. If he is traveling inside the vehicle, that will be enough to get the claim, right? But now, as far as our four companies are concerned, we are using the same old tariff rates. So we are paying even if the person is not driving the vehicle. But nowadays, some private companies are modifying the wordings by file and use. They are modifying the wording as while driving the vehicle. In those cases, the insured get compensation only if he is driving the vehicle and dies in the accident. Right. So what is the coverage? It is only table 3 cover in PA policy. That means death, then PTD, permanent total disablement, and loss of limbs. Only 3 covers. Loss of limbs are eyesight. So that is table 3 cover under the PA policy. We have already discussed, suppose a person is having more than one vehicle, he can go for the standalone CPA policy. Suppose a person is having 4 cars, he has taken CPA cover only 1 car, believing that he will not travel in other 3 cars. But one day he is traveling the other car and dies with the accident, the cover is not there. Absolutely, the claim is not payable. The owner driver cover is eligible only when the person is either driving the car or sitting inside the car and meeting with the accident and died. The registered in his name, he is having a driving license, and the premium is paid in that car for owner CPA. That's all. Very simple. Many people are asking, sir, I have 5 cars. Then why in all the cars? Yes. If you want coverage, you should insure yourself in all the cars and 2-wheelers, or you go for standalone CPA policy, where you are paying only one premium and cover any number of vehicles. That is the only choice available. So next PA, unnamed. Very clearly it says this optional cover other than owner driver. Other than owner driver. Who can be covered by owner driver cannot be covered by this section. Very simple, right? So this section covers unnamed. One condition you should remember, when you come to this section, they should pay premium for total number of seating capacity. Take the example of private car. It has seating capacity of 5. They cannot take unnamed PA car for 2, 3, or 4. They should take it for 5. Some may argue, sir, I am paying paid driver also. So I balance 4 only I will take for unnamed PA cover. No. Because it is not compulsory that all the time the paid driver is driving the vehicle. Suppose I can give the car to my relatives, they are driving the vehicle, 5 persons are there, other than no paid driver is there. So always this section you should cover for total seating capacity only, and premiums, they are different for different types of vehicles. Private car, it is 5 per 10,000. Motorcycle 7 and commercial vehicle 6. Suppose you want to take 1 lakh, it is 50 rupees for private car, 60 rupees for commercial vehicle, 70 rupees for two-wheeler. It is unnamed. You should take for entire seating capacity. Then legal liability for paid drivers, 50 rupees you have to pay. There are two sections, IMT 28 and IMT 29. IMT 28, it is for paid driver and cleaner. You are paying 50 rupees covering legal liability. Why you are paying 50 rupees? Suppose you are not paying 50 rupees, whether there is compensation available for paid drivers or not. Yes, compensation is available, but as per WC Act, not as per common law. Once they are paid by the insured, they are naturally becoming the employee of the insured. So the employees are covered by the WC Act, right? So they, as per WC Act, they are automatically covered, even if this 50 rupees is not paid. But once this 50 rupees is paid, they can go to the MACT court and claim like any other third party. Claim like any other third party. For that purpose only, this 50 rupees is paid. So IMT 28 is used. Now come to IMT 29. The employees, other than paid driver and cleaner, the car is registered in a company's name and employees are traveling. Take the example of our pool car or the car owned by a DM. Registered in company's name. Other than DM, some employees also traveling, right? When some accident happens, the employees gets injured. Without paying this amount, they are not at all covered. So IMT 29 is a must because employees traveling inside a car owned by the employer is not treated as a third party. So they cannot claim compensation. So they need to pay some amount and take this extra cover for IMT 29 till last year. But now IRDA, because of so many legal cases have come, the employees are traveling inside the car are not covered. So the IRDA said now IMT 29 is free. So they need not cover, they need not pay anything, but the employees are traveling inside the car owned by an employer is automatically covered as third parties and they can claim the legal compensation for their death or injuries. So now it is free. Earlier it was 50 rupees per employee. Come to GR 37. Cover for vehicles imported without customs duty. Sometimes what happens, some sports persons are getting the car as a reward in an abroad tournament. They are bringing the car inside the India. The government is allowing customs duty exemption to recognize their achievements. So the car is coming inside India without customs duty, right? So we are, whatever the ex-showroom price only we can insure. That means excluding customs duty only because they have not paid the customs duty, right? But when the car is getting damaged, the spare should again come from abroad. But in this case, the spares are not exempted. They will be subject to customs duty only. So if we are not getting some extra premium, we will be paying more for the spares which are imported in case of accidents. So the cars which are exempted from customs duty are loaded by 30% on OD premium. So you should remember the percentage and also the reason why it is loaded, right? GR 38, vehicles requested by the government. During so many process like election process, our government is going for a raid, the vehicles owned by individuals are taken by the government for their own purpose, right? Suppose when the car is in the possession of the government officials, an accident happens. Sometimes the government is compensating the losses or sometimes give partial compensation of the losses. So our policy what says, even the possession is taken by the government, our policy continues to the extent what is not covered by the government compensation. Suppose the damages are 1 lakh, the government is giving only 40,000, the remaining 60,000 can be claimed by the policy. So even when the possession is taken by the government, our policy coverage continues. That is the main point. Suppose the compensation is given by the government, that should be reduced by the claim payable by us. Property damage we have already seen. Statutory requirement is only 6,000. But all our policies are automatically covered for 1 lakh in case of two-wheelers and all other vehicles 7.5 lakhs of property damage. Suppose the insured is saying, sir, I don't want the additional cover, only 6,000 cover is enough for me, then there is a discount. 200, 150, 100, 50. In the sequence, you should remember 200 for commercial vehicles, 150 for taxi, 100 for private car, 50 for two-wheelers. This is the discount given by us when the insured is opting or reducing the property damage cover from existing 1 lakh or 7.5 lakhs to the statutory requirement of 6,000. Right? You should remember the limits and also the discounts. 200, 150, 150, risk-based. Highest risk 200, next risk or taxi 150, private car 100, less risk 50, two-wheelers. This is excess, compulsory deductible. I have given a clear-cut table. There is no other choice. You have to remember these values because in case of numerical problems also, this value will be asked, right? Now, easily rememberable, first we remember. Two-wheelers 100, two-wheelers 100, private cars 1,000 and 2,000. 1,000 for vehicles up to 500 cc, 1,500 cc, 1,500 cc and above, it is 2,000, right? Come to taxis. Taxis and three-wheelers not exceeding 1,500 cc. 500 and 1,000. Same as private car, the cc, but 50% of it. Less than 1,500 cc for private cars, it is 1,000. For taxis and three-wheelers, it is 500. Here 2,000, here 1,000. Right. Now come to goods carrying and passenger carrying vehicles. It is top of the table. You should remember this bifurcation. First one is 7,500 kg, then up to 7,500 to 16,500 kg, above 16,500 kg. In passengers, it is 17 passengers, 17 to 36 passengers, more than 36 passengers, right? Excess is 500, 1,000, 1,500. So you should remember this bifurcation: 7,500, 16,500, more than that. 17, 36, more than 36, right? So 50,000, 1,500. Okay. Now come to miscellaneous vehicles, Class D vehicles. Class D vehicles, it is not the fixed amount. It is 0.5% of the IDV, subject to a minimum of 2,000. So miscellaneous types of vehicles, when the IDV goes up, excess is also goes up. For example, in case of private car, even if the value is 1 crore, the excess is only 2,000. But if the miscellaneous types of vehicle, if the value is 1 crore, it is 0.5%, that is 50,000. So 50,000 will be the excess. So you should remember this: 0.5% of IDV, subject to minimum of 2,000. All trade plate policies, 50 rupees for two-wheelers, 500 for others. Very simple. All trade policies, EFG, we will see in the afternoon session. It is 50 rupees for two-wheelers and 500 for all other vehicles. So as I said, you have to remember all these tables, all these numbers, because Definitely you will be asked either in the direct question or in the problems. Okay. This IMT 21, we will see elaborately in the afternoon session. What is IMT 21, what is IMT 23 and all. We will see elaborately. So I am ignoring this slide. We will see in the afternoon class. Electrical and electronic fittings. Very simple. Same logic is applied for electrical electronic fittings, LPG or CNG kit. Same logic. Whenever the electrical electronic fittings are coming with the vehicle, manufacturer himself is supplying them, and the value is already included in the ex-showroom price. They need not pay anything. They are automatically covered. Automatically covered. Suppose the insured is fitting some electronic items after the buying the vehicle, then he should declare it specifically. What is the item? What is the value? And pay 4% extra on the value. Then only those items are covered. So the items which are fitted after the purchase, they should be declared value wise, item wise, and it should be paid 4% paid. Then only they are covered. What are all coming with the vehicle, they need not declare, need not pay. Need not declare and need not pay. The same rule applicable for LPG CNG kit, right? Suppose it is inbuilt, nothing is payable except 60 rupees. After the purchase, then 4%, right? Here you see, suppose it is inbuilt, the company itself, manufacturer himself is giving, then only 60 rupees per vehicle is charged under the liability portion. Because under the OD portion, the value of the kit is already covered in ex-showroom price, nothing is payable. But to cover the extra risk, this 60 rupees is payable under the liability section if the CNG LPG kit is given by the manufacturer inbuilt, right? So the same logic for electronic items and this LPG kit. Fiberglass fuel tanks. It is only in commercial vehicles. The fuel tanks are made by fiberglass. It is very fragile. So we are charging a loading. The fiberglass fuel tanks, the vehicle is having fiberglass fuel tanks, 50 rupees under one damage section for all vehicles except Class D vehicle where we charge 100 rupees. So 100 rupees for Class D vehicles, for all our vehicles 50 rupees. GR 44, the vehicles used for driving tuitions, where the vehicles will have double clutches and double brakes. That means the driver and also the co-driver, both of them will have clutch pedals and the brake pedals. So such vehicles are licensed for driving tuition by the RTAs. So we charge OD portion, OD premium plus 60% loading on one damage portion only. Liability portion as per tariff, no loading, right? So you should remember, OD portion alone we are charging 60%, and liability portion we are not charging anything extra. Restricted cover. I told you the insured is having option to cover the vehicle only for fire, only for theft, only for fire and theft, right? So what is the premium? 0.5% for fire, 0.5%. For theft alone, it is 0.5% of IDV, and fire and theft 0.75% of IDV, right? All other conditions applicable, same. But it is prohibited for classes D, E, F, G. D is for special types of vehicles. E, F, G are trade policies, motor trade policies. So it is not applicable for these three category of vehicles. As I told you, I can have restricted covers plus liability. That is fire plus liability, theft plus liability, fire plus theft plus liability. So for that, fire plus liability means liability premium as it is, no change, plus 25% of the OD premium. Theft alone means liability plus 30% of OD premium. Liability plus fire and theft means liability premium plus 50% of OD premium. What are the perils covered by fire and theft cover? Except accidental external means. All the other 9 covers are there, or 9 perils are covered. It is prohibited by Class D vehicles, we have already seen. So all other discounts, everything is eligible for this fire and theft policies also, including NCB. Vehicles driven by non-conventional source of power, like electric powers. It was very old tariff at those time. Electric vehicles are almost not there. So they have given a mandate how to cover the electric vehicles. Private cars, all the electric vehicles to be covered by 1000 cc. Two-wheelers, it should be rated as 150 cc to 350 cc. It is old, only for tariff, only for exam purpose, you should remember. But current rates are defined in a different manner, right? It is depending on the HP. We are putting the rate. All the types of vehicles are there. So you don't compare this provision with the charges we are making in the office now. For electrical vehicles, we have different charges now, right? Only for tariff provision and exam purpose, you remember this. This is the new GR which was added to the 47 GRs already there in 2002 July. In December 2022, they have added this. You know what is the towing charges? Towing charges for two-wheelers is 300. For all other vehicles, it is 1,500 rupees only. But nowadays, it is not enough. The insured wants to have more towing charges. So this is the table where you can remember how much premium to be charged for having additional towing charges. The table is difficult to remember, but you can remember the amount by which the towing charges can be enhanced, right? For private car, normal cover is 1,500 rupees. You can enhance it by another 1,500. That means totally 3,000. For two-wheelers, 300 rupees is normal cover. Another 300 rupees is extra cover. So 600 is the maximum, right? Commercial vehicles only, you can cover maximum up to 10,000 for taxis. All other commercial vehicles up to 20,000. It is over and above the regular towing charges. So this amounts you should remember compulsorily. This amount of charges, if possible, you should remember, because there are only 2 slabs, 5 and 7.5, which are 5 and which are coming under 7.5. You can remember, if possible, right? They cannot go that much deep. So you just remember these points. How much it is enhanced and what is the percentage of additional premium charged. 5% means 5% on the additional amount opted. Suppose they can opt from 0 to 1,500. They are opting for 1,000 rupees. They should pay 50 rupees. If they are opting for 1,500 rupees, they should pay 75 rupees. That's all. More than 1,500, they cannot opt. GR 48, submission of statistics. Earlier it was TAC, Tariff Advisory Committee. It was devised by Tariff Advisory Committee. So all the insurance companies are mandatorily has to give the statistics of premium received and claims paid to the TAC. Then only they can go for actual valuation and decide the new premiums chargeable, right? Now it is IRDA. So IRDA has a right to request the statistics, right? So 48 GRs are there. 49 means interpretation. Interpretation, if there is any ambiguity, it lies with the Tariff Advisory Committee. Now it is not Tariff Advisory Committee, it is IRDA. So this is the circular 16/12/2022, which introduced the additional towing charges, right? So this is the class of vehicles. Sometimes they are asking what is A1, what is A2, right? A means GCV, right? A means GCV. 1, 2, 3, 4. Other than two-wheeler, public carrier, private carrier. Again, you might have been remembering that there are no private carriers in the tariff now. Private carriers, this class itself is removed. Goods carrying vehicles, only public carrier is there now. There are now private carriers, right? You should remember that also. That is the current change. So these classes also, if possible, you remember, otherwise leave it. This thing you should remember. A for goods carrying, B trailers, C for passenger carrying, D special type, E, F, G, it is for motor trade policies. These definitions I have added prior to this new Motor Vehicles Act, which was passed in 2021. So in TP section, I have requested the faculty, she will cover these definitions. What is fitness, how many days this driving license is required, what is the eligibility for driving license, fitness certificate, everything she will cover. Okay. So this is only for GIAs. As I told you, the second portion, afternoon session, we will cover the tariff portions applicable for each class of vehicle and also the trade policies. So we will break now. Again, we will assemble by 2 o'clock exactly. Please confine to the timings because we have to cover a lot of portion. So please come again, assemble at 2 o'clock. Thank you.